Rajat Jain to talk about markets and to take our conversation forward as to where the fundamental picture is. He's Chief Investment Officer with Principal Asset Management. Rajat, how much more to go before we reach a fundamental bottom for this market? Because there are just too many moving parts right now, whether it is global trade war or local liquidity crunch stroke slowdown.
Good morning, Nikun. Yeah. I think yes. So currently, obviously, the market's going to focus first of all in terms of events. You are right. There are many moving parts to this: the global macro, the global geopolitical situation, and obviously now we have the big event. At least we have the union budget coming up in a week's time, or say about 10 days time from now. And I think the market's going to watch for all of those, but especially in the budget, the two things we're going to watch for. One, as we know, the government is facing some sort of issues on the fiscal side, simply because the revenues last year growth was muted, both direct and indirect taxes. Disinvestment was a bit of a challenge. And expenditure, obviously the government has got some new schemes in the social space, which are going to take some, which we need to be funded as well. So A, what we do in the fiscal deficit, and I think a small breach of fiscal deficit and goes into productive capacity creation will not be taken too amiss, and that's one. And secondly, in terms of the policy statement on the speech as to what they're going to focus on, we expect they'll be focused on infrastructure and roads, housing. Obviously, we had the minister speak again yesterday on the Awas Yojana. So all of that. So I think the market's going to listen to the speech in terms of what the policy focus the government is going to have, the fiscal situation particularly. And if you leave that, the very near term, the budget out for the moment, then obviously we'll come back to earnings. And we have been disappointing for a long while. FY20, the expectations are simply because corporate banks dominate the earnings. We should get a fair set. I mean, the consensus is somewhere between 20 to 25%. And we just see how earnings play out for the rest of the year. So overall, I think with all this sort of volatility, news flow linked to global oil prices, all of that, and the domestic fiscal situation, probably 20 will not be a great year. More like an average year is what we think for equity markets.
Rajat, but all the pointers that you talked about, do you think they would be enough and sufficient to revive the animal spirits back in the system? Because, what is amiss is confidence of putting money at these levels.
See, I think it's. I mean, I don't think. I mean, see, ultimately, okay, the private. If you look at when you talk about the animal spirits, we are seeing limited amount of private. A lot of the capex has been on the infra side, or say solar power plants and roads and so on. Railways obviously has had some capex as well. There's little capex on the traditional, which were capex heavy sectors for the economy, which was say like metals or power capacity creation and so on. We're not seeing much capex there. Though if you look at the RBI data, the capacity utilization numbers are tending to be like the mid 70s to mid to high 70s. So we should see some, and we are seeing some of that. I mean, we are seeing some of that happen. But we don't see in terms, when you say animal spirits, do we see large capex coming up from private sector this year? We don't see that as certainly not in FY20. Though we are, if you look at the data, I mean, you've seen CMI data last, I think 2 to 3 quarters, there has been some revival in terms of demand for industrial capital goods, but it's not the way we had, say, about 7, 8 or 9 or 10 years ago. So there is some bottoming out of that, but we don't see a great comeback of that in FY20.
So Rajat, we've got about a double-digit gain in the first 6 months of this calendar year. Given where the lay of the land is, earnings, your view that we will be for an average year, are we done for next 6, 8, 10 months? I mean, can we kiss goodbye to the markets because it could be a sleepy and a zombie market?
Yeah, I mean, calling the market, as somebody said, I mean, you can call the move and the timing, and it's impossible to do so. But my sense is, yes, it's looks more like a front-loaded year. We had a most of the returns probably in the first half of the year. But then events like the budget, for example, suppose, there is a big reform thrust that the government comes out with in, say, things like factors of production, say something on, say, labor reform or land and so many things, and you see FII inflows, FPI inflows. So I think things can change, but so a lot of moving parts, as you said earlier. But absent that, I think we seem it's more like a front-loaded year. So most returns probably come in the first half of the year.
Okay. From that perspective, Rajat, and since you're expecting things to be average, really, where does one look for returns then? Is there an opportunity at all in certain pockets, or maybe in the broader markets, where one could still hope for multifold returns?
See, I think the markets and the habit that the markets have, it's not linear markets. You see, they don't go up in a straight line, so you have ups and downs. So, and then suddenly you have a great year or a couple of great years. So, come back to your point that you made initially. About where do you see opportunities? If you look at our portfolios, there are two areas. Say one is obviously, I think that's a consensus call as well, is long corporate-oriented banks, and we know the story there. Most provisions, incrementally slippages are low. The bigger banks are getting capital. PSUs certainly, the bigger ones are getting capital. The private sector banks have raised money as well, so there's opportunity for them to grow. And provisions are mostly behind them. Aging-related provisions are behind them as well. So that's an area that looks interesting. NBFC competition has sort of certainly come off substantially. And that's one. Cement is another space that it's not a very large sector, but we do have, say, about 4 to 4.5% of our portfolio in cement. And again, coming from the fact that demand growth is holding up, and given the infra spend, housing, and so on, I think that should do reasonably well. Capacity creation for next couple of years is going to be moderate, not great capacity creation. And then the services, say hotels, for example, there's been no capacity for a very long time. So we're seeing decent traction in hotels. Telecom is another space where competition, ultimately, we're seeing bottoming out of prices there. So many, the bottom of picks otherwise, but it's really, there's no real single theme that stands out as of now in the markets.
Using the distress in consumers to buy durables or staples, or do you think they're still expensive?
I think there's no distress in the stock prices of staples. They may be. So there is, so consumer durables, absolutely, I think we should see, the sense even from the commentary from the management says that second half may hopefully begin to look better. So I think consumer durables look interesting at some point of time. Staples clearly we are seeing growth. We are going to see growth there, but expensive, very expensive valuations there. So slightly more cautious, probably cheaper staples is what we have in our portfolio. But yes, durables at some point of time certainly look interesting.
Okay, so that's the view coming in there on that pocket of the market. The thing is, Rajat, that going ahead, you were talking about, you touched upon earnings as well. And it looks like in some of these segments, the demand pressure is continuing, margin pressure is likely to continue as well as they try and find, really ways to expand the market going forward. So once again, I repeat, because you've been so forthcoming in the fact that you're not really expecting much from some of these pockets, would you really be very stock specific? Are there certain parameters that you're looking at, or are you just telling investors to expect, a certain sort of average minor returns?
No, I say, okay, what I spoke was for FY20. So FY20 we don't see is going to be a great year in markets. As I said, they have this habit of going sideways and then they sort of rally. So two things. So this year I think because of the macro, I think the market is going to take stock of what the government policies are going to be and so on. That's why. And I think it's also forming a base for, I think, small and mid-cap companies in some sense. because they have corrected substantially. And mid caps, unlike large caps, there are mid caps and small caps and small caps. So really can't lump them all together. So what we are finding is fairly decent quality small cap name, fairly decent quality mid cap names available at reasonable. I mean, nothing is cheap, but you say getting good companies at say low teens, for example. So I think that's a good option to invest into them with a 2 to 3 year sort of a perspective. So I think that's one area that looks interesting. There's no need to rush. I think markets still are going to give you opportunity, but yes, I think that is something that certainly looks interesting at this point of time. Other than that, in the large cap oriented portfolios, it is going to be very bottom up. You are finding opportunities selectively, so it's more bottom up in the large cap names.
Observing the way some of these pharma stocks have underperformed, the fact that valuations are at a 9-year low, you do not see any possible triggers for pharma growth just on the horizon. Perhaps one would have to wait it out. But would you say purely because of a price move and the kind of bottom-up stories that you can get within pharma right now at lucrative prices, maybe selectively one can nibble into pharma, or would you say still in a void?
Yeah, and two things. One, in pharma, I mean, we have seen in terms of generic prices fall. I think that's come off. Still, there's a fall of say 4 to 5% annually. It is much better than what it used to be earlier. That's one. Regulatory action, it seems to be behind, but then we've got some more cases coming up. But I think overall, I think Indian companies, as I have always said, have good chemistry skills. We've got to improve our processes. So, there is some regulatory action in FDA inspections and warnings and so on, but most of it I think seems to be behind us. So I would actually, we are neutral pharma in our portfolios. So I think there is a space for pharma, but selectively, especially in companies which have, complex generics who are focusing on that. And commodity generics is sort of behind us. We are not going to see we may see volumes, but not much money to be made there. So companies who are filing for complex molecules, generics, I think they certainly look interesting. And they are both large sized companies and large mid-sized companies. Both of them look interesting.
Comments from you, Rajat. Today headlines are bad. Whether it is about NBFC or slowdown in car or what will happen to the rural economy. When do you think headlines will start changing? And when do you think markets will start ignoring bad headlines? We are in that phase of the market where everybody is reacting to the news first without understanding the impact of that. When do you think this will change? Because this kind of a sentimental overdrive or sentimental over bearishness is not going to continue.
Yeah, it will. I mean, you're right. It has to change somewhat. Probably when everybody is bearish is when you see this change. But I think, there are, markets are never perfect, you see. I mean, there are extreme bullishness, extreme bearishness. Probably we are not say extreme bearish, but we as in the market. The market, as you said, markets reads the headline, sells first, ask questions later. So be it about say NBFC issues or auto slowdown and so on that you mentioned, but I think at some point of time market will find value. But as of now, the dominant sentiment, at least among the retail investors, among the average market participants, one of fear trumping greed. But that can't last. I mean, we don't know when that's going to turn. Probably if there are no more accidents on the NBFCs, no more fresh accidents on the NBFCs. Liquidity has eased. It's not that liquidity has not eased for NBFCs, but then banks are being selective as to who to lend to. So it's not that, I don't think it's going to be a systemic issue. I think that's the most question that's raised is this NBFC is going to make it a systemic issue. I certainly don't think as of now, it doesn't look likely. This issue is limited to certain names, and overall I think liquidity for NBFCs as a category, the cost of the money may be higher, absolutely, but are they getting money? And they seem to be getting money more easy than what they were getting earlier. So all that, I think as time passes by, hopefully sometime the markets will turn, though I don't know when that's going to happen.
All right. That's the view coming in from Rajat this morning. Thanks so much for joining us, Rajat, and taking us through your view on things as they stand.